So good morning, everyone. Welcome to day three. Team, am I audible? Is the screen visible? Okay, great. All right. So for those of you who are new, I am Paritosh Panchal, and we have already done 2 days of revision. The first day we looked at certain exam tips and tricks, and on day two we revised advanced investment appraisal. Today we'll be doing advanced risk management. So we'll do a little bit of theory and then we'll solve two questions of section B, right? So without any further ado, let's begin. So I've taken these from the study hub. It's an extract from there. So we'll be discussing very briefly foreign exchange risk management. Now, we obviously won't be able to do the entire thing, but we will just discuss two methods, that is money market hedge and futures. Money market hedge, why? Because often ignored by a lot of students. They primarily focus on futures, options, and forwards, and they tend to ignore money market hedge. And you never know what comes in the exam, right? So therefore, I decided that it would be a good idea to go through money market hedge. It's very simple, very easy to score marks if you get a question on money market hedge. All right. So firstly, the definitions, uh, the spot exchange rate and the forward exchange rate. There's also the futures exchange rate. Spot means right now, on the spot. If you had to convert something, then what rate would you get? That's the spot exchange rate, right? And forward exchange rate is something in the future, all right? But you are fixing it right now, in the sense that, say, for example, you require $1 million after 3 months, then you are locking a rate today. You are getting a rate today. And just a moment, the light is hitting my eyes. I think this is better. Yep. So the forward exchange rate would be you are setting the or fixing the rate today for some future date. Like you are locking in a rate that I want $1 million after 1 month. Please give me the rate right now. That's your forward rate. Okay. A money market hedge. See, money market hedge is a way of kind of fixing your exchange rate without entering into any derivative instruments, but it's just a combination of transactions wherein you are taking a loan in one market and you are investing in another market. So how do we decide where do we take the loan or where do we invest? Okay, the simple hack for it would be you just need to ask yourself that in foreign currency, what is going to happen? Are you going to receive the foreign currency or do you have to pay the foreign currency? Right? If you are to receive, now wait, let me just put it on the spreadsheet. Okay, I'll just go down. I'll just make a new sheet. I don't like these grid lines. Okay, so say for example, you are an importer. Okay, so in that case, right, you are an importer. So as an importer, you will need to pay foreign currency. Okay. So since you need to pay currency, that is, it is a liability. 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 Okay. So you have to pay the foreign currency. That is, you have a foreign liability. So what will you do? You will create foreign asset. That is deposit or invest in foreign currency. Okay. So that's your thought process that would go. Now, in order to uh, invest in a foreign country or in a foreign currency, okay, for this, we shall borrow and arrange, or we shall borrow in home country and convert it into foreign currency to deposit there. Okay. So this is your line of thought. The first question you ask yourself uh, is there a foreign asset or foreign liability, or do I have to pay in foreign currency, or am I going to receive in foreign currency? Now, if I am to pay in foreign currency as an importer, that means I'm creating a foreign liability. In order to settle that liability, a future liability, we will create a foreign asset today. So, um, as an importer, we have to pay foreign currency after 1 month. Now, I've just given one example of a month or 2 months, 3 months, whatever. In a future date, we are to pay the foreign currency because we have imported goods today. So that basically means that we are kind of like creating a foreign liability which will arise after 1 month. So to counter it or balance it out, we need to create an asset today so that that asset matures. Whatever inflow you get from the asset will be utilized to satisfy the foreign liability. So the foreign asset is going to generate income, and the foreign liability will take that income, and both will get nullified. Okay. Now, in order to create an asset today in the foreign country, where do we have the money? We don't have the foreign currency yet. So we need to arrange for it. How are we going to arrange for it? We will borrow from our home country, convert it, invest it. Once the investment matures, we satisfy that payment. Okay. So now everything is fixed, right? The interest rates are fixed. So there is no volatility, and therefore you have kind of hedged or kind of a fixed a rate. Now everything reverses when you are an exporter. Okay, as an exporter, you have to receive foreign currency after 1 month, which means foreign asset shall emerge or arise after 1 month. Therefore, create a foreign liability today. That is, take a loan in foreign currency. For this, we shall, or rather, with this money, with this foreign currency borrowed, we shall invest in home currency by converting the loaned or by converting the borrowed foreign currency. Okay. So if you are an exporter, that means you are to receive the foreign currency after a month. So that basically is like an asset, and to which means the income will get generated. Now, this income will go to satisfy a liability that you are creating today to balance it out. Okay, so you will take a liability today. That means you are taking a foreign currency loan. This now, what are you going to do with the foreign currency? You are going to convert it into your home currency and invest it, right? And once the investment matures, you get money, and when the payment is received, that receipt is used to satisfy the loan. Okay, but however, there is one risk that what if the person doesn't pay you on time? In that case, you have a foreign liability that has risen, and you would still have to pay it. Um, because the bank is not going to recognize that, oh, your customer defaulted, so okay, we'll let you easy. No, that's not going to happen, because the bank is going to say, we had a deal with you, you promised us, we don't know about your other transactions, right? So this is how money market hedges are done. It's very, very, very simple, and very easily can you score marks in this. Now, in the exam, do not write asset liability. This is just for your understanding purpose. Right. So a money market hedge is a technique to lock in the value of foreign currency transactions in terms of the organization's domestic currency using a combination of investing and sorry, combinations of investing, borrowing, and a spot exchange, currency exchange. Suppose a UK company has a dollar export earning. That means it's going to create an asset in the future. The money market hedge would be set up by following. Since an asset is going to be created, we are going to balance it out by creating a liability. That is, we are going to borrow dollars today at the company's fixed rate dollar borrowing rate for repayment when the dollar earnings are due to be received. The intention is that the dollar earnings will repay this dollar loan. Then whatever dollars we have borrowed, like we have taken a loan of, we shall exchange these dollars into sterling at the current spot rate and invest the sterling received at the company's fixed rate sterling investment rate to mature on the date of the dollar earnings are due. So we borrow it, convert it, and then invest it. So three-step process. A money market hedge effectively produces a homemade forward exchange rate. The resulting exchange rate depends on the interest rate differential between the two currencies. So you have effectively just locked in a rate. So for instance, a UK company expects to receive $300,000 in 3 months' time. The spot rate is given. It's a dollar per pound. So 1 pound is equal to either $1.7818 or $1.7822. 1 year sterling interest rates is 4.9 and 4.6 for borrowing and investing. Obviously, there are going to be different interest rates. In case, if in the question in the exam, if you are given the same rates, then you could be a skeptic and you could say that the interest rates, or you could display your commercial acumen by saying that in the real world, the borrowing and investing rates are often different to each other. Okay, usually the borrowing is always more expensive as compared to investing. Just think of it, right? When you go to the bank to create a fixed deposit, you will always be offered a lower rate as compared to when you go to the very same bank to take a loan, right? So 1 year sterling interest rates have been given for borrowing as well as investing rates, and 1 year dollar rate has been given. We are required to set up a money market hedge, right? So very simple. Firstly, you ask yourself that in the foreign currency, is it an asset or a liability? In this case, we are to receive. That means it's an asset. To balance this out, we shall create a foreign liability. That means in dollars, we are going to borrow, which means the applicable rate will be 5.4%. Okay, now these dollars that we have borrowed, we shall convert it at the spot rate. Now we have been given two spot rates. The easy way out is converting it with both the available rates, and whichever rate gives you the least amount of pounds, that's your correct answer. But if you do not want to do two times calculation, very simply just logically think about it. You are going with dollars, okay, to the bank in return will give you pounds. Now, these quotations are given per pound. So, for every 1 pound that the bank gives you, okay, will it take 1.7818 or 1.7822? Obviously, it's going to take a little more from you, right? So, it's going to take $1.7822 and in return just give you 1 pound. Okay, so the relevant spot rate for us is 1.7822. Okay, at this spot rate, we shall convert our dollars into pounds and then invest in the UK at 4.9%, right? So let's just go through it. Expected receipts after 3 months is $300,000. The dollar fixed rate borrowing interest. So now we need, one more thing I forgot to mention is these are per annum rates. Okay, we are to invest only for 3 months, so we need to convert these annual rates into 3 monthly rates. So it's just simply 3 months divided by 12, so which is 1.35%. So dollars to borrow now have a $300,000 liability after 3 months. So $300,000 divided by 1 plus R. Okay, it's kind of like you are discounting. You already have the future value. In the future, the value should be $300,000. What is the present value? You have the interest rate. So 1 plus R. You won't do raise to N or anything because you have already adjusted the rates. So just the future value into 1 divided by 1 plus R will give you your answer. Or just no need to do even into 1 divided by 1. Just do a simple division, right? And you will get your present value of that loan. So that means you are to borrow this much, $296,000 today, convert it at 1.7822. Again, I told you the logic behind 1.7822. But if you want to be double sure, you could do a quick calculation and find out. You can convert using both the rates and find out in which rate do you receive less pounds, because banker always wins. Okay, banker is not going to allow you to make a profit there. The bankers would make a profit from the spread. Okay, so you will always receive the lesser pounds. So anyways, with logic also it's 1.7822. So technically you are receiving 166,000 pounds upon conversion, and this amount you are investing, okay, so at 4.6%, but only for 3 months. So you could do $166,000 into 4.6% into 3 by 12, and you shall receive the amount after 3 months. Okay, that is 167,000, almost $168,000. Sorry, 168,000 pounds after 3 months. So after 3 months, what happens is you are receiving $300,000. These dollars are used to satisfy the loan that you have taken, because your loan matures. The banker gives you a call, says that, hey, you have to pay me $300,000. You will say, yes, I have it. Okay, then you will contact your own bank in the UK and say that, hey, I had invested some amount, it matures today. So they said, yes, it has matured to $168,000. Sorry, 168,000 pounds. So basically, a $300,000 inflow has resulted in 168,000 pounds of inflow, right? So you have fixed your rate in this manner. So that's your money market hedge. If you had to do the opposite, if you had to think from an importer's point of view, in which case you would invest in dollars and borrow in the UK pound. Just a moment, want to just drink some water. All right. Now, currency futures contract. Futures contract is a standardized contract between the buyer and the seller in which the buyer has a binding obligation to buy a fixed amount at a fixed price on a fixed date of the same underlying asset via a recognized exchange. Futures are simply standardized forward contracts that can be traded on the exchange. See, understand, futures is a derivative instrument. It derives its value from the underlying. So I like to treat these derivative contracts like boxes. So we always say in the class, okay, don't give these examples in the exam. Okay, this is just for your better understanding. Okay, so treat these futures contract like a box within the box. Now, what is the value of a box? The value of an empty box is nothing. What matters is what's inside the box. So similarly, futures contracts are boxes, but inside there is something. It could be $100,000. It could be 500,000 pounds. It could be anything. So what is the underlying? That's, we call it the underlying. Okay. So what is the underlying? And we define something known as the contract size or the lot size. That means in one box, how many dollars are there? If there are $1,000 in one box, that means one lot or one box is equal to $1,000. What is the underlying? Dollars. How much? 1,000. Okay. And this box will be sold to you at a fixed price. Okay. This price is the future rate, the future exchange rate. Now it depends what's inside the box. When what's inside is foreign currency, though, so the prices will be the exchange rate. If it is a loan, okay, then it will be an interest, right? So that basically you are effectively fixing a rate beforehand. However, they are not super accurate. Reason being, there's something known as basis. And what is basis? The basis, a simple definition for basis, is the difference between the spot and the future price. See, a future contract has a set expiry date. That is, you can open the box, or you can, you could technically just open the box and utilize the dollars in the box only on a specific date, that is on expiry. Before that, if you want to, uh, you know, hedge, in that case, you will have to sell the box and receive the money. So the settlement is done only on the difference and not the entire amount, right? Um, so what happens is that if you want to, what was I saying? Yeah, so there is a fixed date or expiry. No, I was talking about basis, sorry. So if you want to open the box, you can't before the expiry, right? So before expiry, if you are to sell, there is a pricing mismatch between futures and spot. Okay, there is a slight difference between the two. That difference is called basis. Now, on the expiry date, this basis becomes zero, right? So, say for example, if you have USD INR contracts or USD GBP contracts, okay, and say you are the expiry is after 1 month, right? So after 1 month, the future rate and the spot rate will be equal. That is, on the expiry date, the future rate and the spot rate will be equal. Therefore, basis is zero. But any day before the expiry, there will be a slight difference between the two. Either the future contracts are trading at a premium or they are trading at a discount. Either or. And it keeps changing, right? So whatever it is, the difference is known as basis. And due to this basis, you are effectively not able to get, you are not able to lock a rate per se unless you wait till expiry. But before that, more or less around that rate, you will get another rate. Okay. So long story short, futures is a way to hedge your foreign exchange exposure. It is a way to reduce the volatility that you are exposed to with regards to foreign currency movement, right? So they are simply standardized forward contracts that can be traded in an exchange. So the difference between forwards and futures are both are obligations. You don't have an option, unlike you don't have a choice, unlike option buyers. Okay. You have to execute it. Only thing is, in case of futures, they are standardized. They are not over the counter. Standardized in terms of the size, standardized in terms of expiry date, okay, standardized in terms of what's the underlying, right? So it's fully standardized and it can be traded in the exchange. So there is an exchange involved, kind of guarantees you that there won't be any default. So in forwards, you do face a counterparty risk. In futures, there is no counterparty risk because the exchange is involved. And exchange ensures that there is no default from either parties through a mechanism called margin system. Okay. Um, the futures market is a market for risk. Speculators use the market to take risk, and companies use market to hedge the risk. Okay, see, there are two types of people in the futures market, or futures and options market, both F&O we call it for short. There are speculators. Speculators are those who trade the security only to make profits, whereas hedge people who are into hedging are entering into these contracts only because they want to reduce the risk. Okay, we are to receive $300,000 or maybe $3 million after 2 months. But after 2 months, we don't know what the exchange rate would be. It could be a favorable move, and we could receive more of our home currency, or it could be an adverse move, and we would receive less of our home currency. Either ways, we are not sure. There is some uncertainty which way the currency would move. So if you want to avoid that, you shall hedge. But if you feel that, oh, there is going to be a favorable move, let me buy today and sell after a month and I'll make a good profit, those are speculators, right? So the objective of a speculator is to make profits. The objective of a hedger would be reduce risk. Okay. The currency futures contracts are standardized contracts for buying or selling of a specified quantity of a specified currency. They are traded on a futures exchange and has various delivery dates, usually quarterly expiry, but in many countries you get even monthly expiry or even weekly expiry for that matter. Um, but here we are going to assume that they are quarterly expiry, so March, June, September, and December. The exact date during the month is set at the specification of the contract, but it's usually towards the end of the month. So typically, when they say it's going to expire on September, we mean the end of September, that is 30th of September. Usually it's mentioned in the exam, but even if it isn't mentioned in the question, then please write it down as an assumption. We assume that the contract expires at the end of the month. The exam question will usually specify the delivery can be assumed to occur at the end of each month. Daily price data may show the opening price at the start of the day's trading, the intraday high, and the low price and closing settlement price at the end of the day. In most exam, it is the settlement price which is more relevant. That is the price at which the deal is being executed when you're squaring it off, when you're closing it off. You have something known as the margin system through which the exchange ensures that there is no default, which basically means that if you have to purchase, say for example, sorry, just a moment. Okay. So how the margin system works is that say you have purchased the obligation by $1,000. Okay, say the underlying is $1,000. You purchase one lot. That means you have to pay $1,000 sometime in the future, right? Now you don't have that much money, or rather you don't want to give that much money today, so the exchange is going to take a margin, that is it's going to take a percentage of the underlying right away from you. Okay, so it would say probably you will have to pay uh say $20, right? And now this what you have to pay would be either in dollars or could be in your home currency, whatever. Okay, but it's like a percentage of the underlying. Now you pay those $20 right away. Now, next day, if the markets move up, that means you make a profit on that contract. So your $20 deposit that you have given as initial margin has now grown to say $25. So that's not of any concern. Okay. Then the next day, it the markets come down, you make loss, and you make a $3 loss. So now your deposit or the initial margin that you had initially put in is now worth only $22. Okay, but it's still sufficient, as in you had paid 20, so it's still more than 20, so you need not intervene. Now the next day, another $3 it falls down. Okay, you make a loss, right? So now that deposit has reached $19. So now you will get a margin call. That means they'll ask you to maintain the initial margin. So if the initial margin that you had to give was $20, now you have to maintain $20 in that account. The value has dipped to $19, so now you need to invest another, or you need to give the exchange $1 extra, okay, and match it to $20. Then if there is another loss of $5, then you have to pay additional. So from $20, now it has become $15, that account. If you want to maintain your position, you need to pay another $5. Okay, only then will you be allowed to hold the futures contract, or else if you fail to honor the margin call, then the exchange is going to square off or close off your position. That is, if you were a buyer, they would sell it. If you were a seller, they would buy it and close it off. Basically, they'll take the opposite position and square off your position and pay you the balance. So say, for example, if you were a buyer, they would sell it off at $15 then, and so you have made a loss of $5. So initially you paid $20, $5 the exchange is going to deduct and going to return $15, the remaining amount to you. Okay. So this is how the margin system works. We'll just look at an example. So successive daily prices on the 125,000 euro futures uh, contract which are sold are, so basically the underlying is 125,000 euros. So in one box there is 125,000 euros. The selling price is 0.6916. So you were to purchase a lot, or rather one unit, for 0.6916. So a lot would be $125,000 in euros into 0.6916. Okay, so that's what you have to pay. But here they have said that initial margins are £1,000 per contract. So what you have to pay initially is you have to pay £1,000. Okay, that's your initial margin. The maintenance margin is 100% of the initial margin. So maintenance margin is, they have clearly said, will be equal to your initial margin, which means you are always have to maintain this £1,000 in the account, right? So you sold this at 0.6916. Then in day one, the prices went to 0.6930. Okay, now you are a seller. You will make money, or you will stand to make a profit when prices come down, because you sold first. Now, in order for you to make a profit, you need to buy at a lower price. So prices coming down is favorable to you. But in this case, prices went up to 0.6930. That means you are making a loss from 0.6916 to 6930. Okay, so that is a loss of 0.0014. Okay, so 125,000 euros into 0.0014 is equal to 175 pounds. That is the loss that you have made. So you have to pay that 175, because from your 1,000 pounds which you gave initially, 175 got deducted. Okay, now your margin available is only 825 pounds. So you need to pump in 175 pounds in order to maintain your position. Okay, so you need to invest or give the exchange 175 pounds additional. You will get a margin call. Your broker is going to call you up and say that, hey, listen, you need to pay 175 pounds. Otherwise, we will have to close your position. You say, no, I am willing to pay you 175 pounds. Here it is. So now that account is replenished to 1,000 pounds and you can maintain the position. The next day, from 0.6930, it further rises to 0.6944, which means you are further making another loss. Okay, of the same amount. So the price change is the same, and therefore another 175 pounds need to be provided to the exchange or the broker to maintain the position. Then what happens is, now finally the prices have come down a little, so you are making a profit. How much are you making? 50 pounds. Okay, that is $125,000, sorry, 125,000 euros into 0.6944 minus 0.6940. That is the profit amount. So that's a 50 pound profit. So in which case you need not pay anything. It's just there. Now your account is worth 1,050 pounds. Okay. This is how margins are to be maintained. So sometimes I think 3 or 4 years back, there was a question on margin also. So as I said, anything can come. Okay, so you can't ignore margin. That's why I have specifically included this topic in it. And then you have your regular futures. I think futures everybody understand. In fact, we'll be doing a question on it. So we won't discuss futures here. Okay, we'll discuss futures in the question that we do. So let's take a quick 5 minutes break and then start with the question. Okay. All right. I hope you are back. Let's begin with the questions. Um, am I covering anything? No. Wait, let me just this line. Okay, this one a little bit. So, but it's just 31st Jan. That's it. Okay, nothing is being covered. All right. So, brand and company. The following exhibit available on the left hand side of the screen. Again, your typical instructions. Um, Now the requirements. Where are the requirements? Yeah, yeah. Explain how the functional area of the Treasury Department could add value to brand and company's restructuring plans, and for each functional area, discuss the advantage of a centralized Treasury Department. Okay, so majorly it's a theory question based on advantages of centralized Treasury Department, but it is in relation to certain functional areas that probably we'll find out when we read the entire question. So basically, advantages of Treasury Department. And the second question is recommend a hedging strategy for the 36 million loan based on hedging choices the treasury manager is considering if the central bank base rate increases to 6.6%. Support your answer with appropriate calculations. Right. So we are planning to take a loan of 36 million, which needs to be hedged. And they are asking us that if in case the base rate increases to 6.6% eventually, then what would have, or if you are expecting that the base rate would increase to 6.6%, then what would be the better option to hedge, to be used forwards, futures, or options? Um, Professional marks will be awarded for the demonstration of skills in analysis and evaluation, commercial acumen in your answer. So 5 marks total for that as well. So 14 marks for calculation, 6 marks for theory, and 5 marks for overall, right? Specifically, analysis, evaluation, and commercial acumen. So practicality also we need to display, right? So let's read the question. Okay. Brandon Company is a holding company operating a small chain of luxury departmental stores in the city center location through the Eurozone. Under the existing structure, the stores are grouped in a number of regional subsidiaries, each with their own head office and treasury function. So, from the first paragraph, our takeaway is that where it is into retail sort of business, luxury stores, and it's in the prime areas, it's in the city centers all throughout Eurozone. So it's multinational. And currently, they are grouped into regional subsidiaries, and each subsidiary, like or each region, has their own head office and treasury functions. So this is currently decentralized at the moment. The board plans to undertake a restructuring exercise in response of a significant. Sorry. Um, yeah, the board plans to undertake a restructuring exercise in response to a significant decline in revenue over the recent years. This involves closing unprofitable stores within the Eurozone while expanding into other more profitable locations worldwide. The proposal represents a significant expansion for the company and will be financed by a combination of debt and equity. Okay, so a decision has been taken, or rather, a plan has been proposed, rather, that certain stores are not profitable, their, or rather, their revenues are declining, so they plan on shutting those down and instead expand beyond the Eurozone, which basically means they are now going to get exposed to even foreign exchange risk. Okay, because they are planning to go worldwide into locations which are more profitable. So they would need that expertise now of hedging foreign exchange. Okay. Now, how are they going to finance the whole thing? With a combination of debt and equity. So, which basically means that they would also require a lot of funding in the near future. The restructuring is due to be discussed at an upcoming board meeting, including the possibility of a centralizing the treasury function. So they are considering centralizing the treasury function. One, we know that we need to give advantages of a treasury function, sorry, of a centralized treasury department based on certain functional areas very relevant to this particular company. So one very prominent thing that comes up is foreign exchange risk management. If you have a centralized treasury department, then it could hedge foreign exchange exposure by matching the subsidiaries inflows, outflows. It could probably even reduce the number of transactions between these subsidiaries by netting, okay, because it has a bird eye view of which subsidiary owes what to which other department or subsidiary. Okay, so netting is possible, matching is possible, uh, hedging of foreign currency by matching and hedging, even by using derivative instruments for that matter, because for derivatives you need an specialized team. So instead of having a specialized team in every various regional offices, it's better to have a one specialized team who's overseeing everything and thereby bringing down your costs. Also, since now the subsidiaries are going to be international, um, transaction costs are going to also become more, because if it was domestic, like, see, within the Eurozone, the transaction costs may not necessarily be that high, but when you're going international, the transaction cost would be high. So you would want to reduce the number of transactions to save on that transaction cost. Okay. Uh, Also, you need to ensure liquidity. So it could basically help you in liquidity management as well. So these are two functions that we just identified: liquidity management and foreign exchange risk management. And also, it requires money, so it could help in bringing the cost of capital down by knowing where to borrow from, how much to borrow from. It could also borrow in bulk on behalf of all the subsidiaries instead of small subsidiaries negotiating a rate for themselves. Centrally, if you borrow, you are in a position to negotiate a better deal. Okay. Transactions to be hedged. Now, assume today's date is 1st of November. Brandon Company's manager predicts a short-term loan of $36 million will be required next year on the 31st Jan to fund an investment in non-current asset as part of the overseas expansion. The loan will be repaid by 31st of May. So, Jan end, we need the loan. Okay, so Feb, March, April, May. So for 4 months, we need the loan. Today, we are in November. Okay, so November full month, November, December, and Jan. So after 3 months, we need a loan for 4 months. Okay, so 3V7 is what we would select now. Well, let's just see if there are more or not. So yeah, we have 3V7 over here. So this is what we are going to select. Okay. Anyways, reading ahead. Brandon can borrow at central bank base rate plus 40 bips. The central bank's base rate is 5.7% currently, and the interest rates have been relatively volatile over the last few years. And the finance director is concerned that the central bank would increase the base rate to 6.6% between now and the 31st of Jan in response to the inflationary pressures within the economy. Okay, so our treasury team or whoever raised that concern, was it? Uh, yeah, the finance director raised it. So the finance director is concerned that the central base rate would actually go up to 6.6% by the 31st of Jan when we require the loan. Okay, currently it's just 5.7. He is expecting a 90 bips rise in interest rates. Okay. So since we require a loan, that would be an adverse movement for us. And why is he expecting a rise in interest rates? Because of the inflation which is in the economy. However, recent media reports have also speculated on the possibility of reduction in base rate. So there are certain reports. Now, we don't know whether how much can we rely on these media reports, but they are speculating that possibly base rates may come down. Okay, but if there are no signs of inflationary pressures coming down, so this is where you can show your commercial acumen by saying that if inflationary pressures, uh, practically, if inflationary pressures do not seem to be cooling down, there is a the interest rates being cut is highly unlikely. Okay, so probably the director is has a proper concern, provided that inflationary pressures are not cooling down. Now, we don't know on what basis is the media speculating a rate cut. Okay. Brandon Company Treasury Manager is considering the following hedging possibilities with objectives to minimize exposure to interest rate risk. So the objective is to minimize the exposure risk, not to make a profit. He is suggesting using FRAs, that is forward rate agreements, or IRG, that is interest rate futures. Interest rate IRF, interest rate futures, or options on interest rate futures, which are IRGs. Okay. The following data. So the underlying of this option is the future rate. Okay. Following data is available. So for FRA, we have three types of FRAs available. Then we have 3-month future contract, $500,000 contract size. The prices are quoted as basis points at 100 annual percentage yield. So these are the prices, or 100 minus the annual percentage yield. That's how typically prices are expressed. So you have for 3 months the future prices, or rather, you could say these are three different expiry. So these are three different contracts. These are three different expiry. Now, we already saw for FRA, we are going to pick up 3V7 because the loan is going to be taken after 3 months and is going to be repaid after 7 months, or after the loan is taken, it's a 4-month loan. So 4 plus 3 is 7. So it's 3V7 will be our uh, correct one that we need to use. Okay. So here it's very straight. FRAs are pretty straightforward. You are just essentially fixing at 5.9%, and that's going to be your effective rate. So even if exchange rates go up to 6.6%, we are going to take the loan at a base rate of 5.9 plus whatever spread that will be a little extra. But from a base rate perspective, because what changes is only the base rate, we are hedged, we have fixed at 5.9, which is more than the current, okay, but is definitely less than 6.6. Now remember, it is an obligation, so in case the media speculations turn true and rates are actually cut, we will not be able to take any advantage of rate cut. Okay, and we would be forced to take the loan at, or the effective rate be 5.9% base. The 3-month dollar future. So here we have three expiries: December, March, and June. So we select the expiry which is immediately after the transaction date. The transaction date is 31st of Jan. So we cannot take December because it basically expires before the transaction. But we can take either March or June. What is immediately after Jan is March. June comes further away. So we can enter into the March contract. Okay, now we need to ask ourselves that, do we buy the futures contract or do we sell the futures contract, right? So for futures, we think, what is the underlying? The underlying is a bond. So when we want to borrow money, okay, what do we do with bonds? We issue bonds, that is, we sell bonds. Okay, therefore we are going to sell these future contracts. Okay, and in case of FRA, we are going to buy. For FRA, the underlying is bank loans. Okay, so you are going to buy a loan, you are going to take a loan, so you are going to buy FRA 3V7 at 5.9%, and you are going to sell futures, March futures, at 93.95. Okay, now futures are standardized, so we need to also calculate the lots. How many lots? So one lot has $500,000. We require how much? We require 36 million. So 36 million divided by $500,000. However, these $500,000, it is assumed that they are 3 monthly loan. Okay, in fact, it's given to us. It's 3 monthly dollar futures. Okay, so it's a 3 monthly loan. So the corresponding period for this $500,000 is 3 months, whereas we need a loan for 4 months. So into 4/3. Okay, so the how do we find the total number of lots that we require? The loan requirement 36 million divided by standard lot size 500,000 into the required period of the loan, that is 4 months, divided by the standard period of the futures, that is 3. So 36 million divided by 500,000 into 4 divided by 3 will give you the number of lots that you need to sell. Now, options on the 3 months dollar futures, $500,000 contract size, option premium are in annual percentage. You have calls or puts. Okay. Now, these are the 3 call options available: December, March, June. Now, we already decided that it's March, and we already decided that we had to sell futures. Since we have to sell futures, that means we want the right to sell, because the underlying is futures. So the decision logic will be same as futures. Okay. The underlying of options are futures. The underlying of futures are bonds. We will sell bonds in order to borrow funds. Okay, we will sell bonds and get money, that is, we are borrowing money that way. So we shall buy the right to sell, that is, we shall buy put options. See, always remember, whenever the objective is to reduce your risk, okay, we will always and always be option buyers, unless you are setting up a caller wherein there are 2 transactions happening. The primary transaction is a option buying, whether you are buying call option or buying a put option, and then you are taking an opposite transaction wherein you are selling. Now, if you are buying call, you will set up a caller by selling puts. If you are buying puts, then you will set up a caller by buying calls, sorry, selling calls. Okay, anyways, in this particular case, it is a loan, that means, sorry, it is a borrowing or a loan. That means we are selling bonds. That means we are selling future. That means we want the right to sell. So we shall buy the right to sell. We shall buy put options. Okay. Which expiry? March expiry. And they have given only one strike. Okay, so no multiple strikes are given, but in case if multiple strikes are given, a safe way to go about it is, and a quick way rather, would be to just take the strike price which is closest to the spot. Okay, now how do we read these? See, understand this: 93.95, 94.07, 93.87. This is nothing but 100 minus 9. Okay, not able to select it. 100 minus 94.07. Okay, so this is 5.93%. And this will be, sorry about that. This will be just 93.95. So this is effectively 6.05%. Okay, and if you want to understand this as a percentage, so this strike is basically 100 minus 6.25%. Okay, this is how you are able to get the implied rate. 100 minus the price will give you the implied rate. So I'm just deleting this to avoid any confusion, but this is how you calculate your implied rate. Okay. Just a moment, drinking some water. All right. So, yeah, so we decided puts, March options, strike price, no decision need to be made in this case. Assume futures and option contracts are settled at the end of each month. Base is assumed to diminish to zero at contract maturity at a constant rate based on monthly time interval. It is also assumed that there is no basis risk and there are no margin requirements. Okay. Now, this is where you can show your commercial acumen by saying that in reality, bases do not reduce to zero in a constant manner. Okay. Therefore, there is something known as basis risk, right? And in reality, you do have to pay margin amount also on futures. So on futures, you have to pay margin. In options, you have to pay a premium. So let's begin. We note down all like a financial summary. So today is 1st of November. Loan is taken on 31st of Jan. Loan needs to be repaid on 31st of May. Loan amount is $36 million. The loan period is 4 months. The rate is base plus 40 bips. Current central bank rate is 5.7%. This is like a financial summary of whatever information is available to us. We are writing it down so that we need not go through the question again and again. Okay, every now and then. The first way to hedge is with using FRA. So hedging borrowing with FRA, assuming that the expected interest rates would go up to 6.6% by the 31st of Jan. Then what's going to happen is we shall select the FRA of 3V7, that is 5.9% shall be taken as loan is required after 3 months for 4 months. So interest payment on the actual loan. So the way the transactions happen is after, like, or rather on the 31st of Jan, we will take an actual loan. The actual loan that we take is at 6.6%. So if you see over here, we are taking the actual loan that is $36 million at 6.6% plus 40 bips. Okay. For how many months? 4 months into 12. Okay. So it's very simple. It's just $36 million into 6.6% plus 40 bips. That is 0.4%. Okay. For how many months? Into 4 divided by 12. Right. So you will get same $840,000. Okay. Now the profit on the FRA. The profit will be the difference between the spot rate, that is 6.6%, and the FRA rate, that is 5.9%. See, since the rates went up, you would call the bank and say, hey, listen, we had a deal that you were to give me a loan at 5.9%. The banker will say, correct. So what I'll do is, now we are assuming that the settlement is done on, so only the difference is being settled. Okay, not the entire settlement. It's not deliverable. Okay, so 6.6% minus 5.9. Wait, let me just show it to you. So 6.6% is the actual loan amount. Okay, but you have the obligation to take the loan at 5.9. So that's the profit. The differential is the profit that you are making. Okay, that is you are making close to 0.7%. Okay. Now this is for a 4-month loan. So 4 by 12 into the loan amount, 36 million. All right, that's 84,000 inflow. That's the profit. So 840,000 is your outflow, the actual interest that you need to pay on the actual loan, and the profit that you are making in the forwards contract is 84,000. So net, your expense total outflow is $756,000. So if you look at an effective annual interest rate or cost of your borrowing will be, wait, let me just shift this here. Okay, so the word borrowing is seen, right? will be 6.3%. How did you find 6.3%? It's nothing but $756,000 divided by the total loan amount. Okay. $756,000 divided by the total loan amount. Now, since we want an annual rate, so into 12 by 4. Okay, keep that in mind. So this is important and this is your final answer. Therefore, I have highlighted it. Okay, so from FRA's point of view, your effective rate is 6.3% and the total cost that you are spending to borrow is $756,000. Okay, now if we look at it from a futures point of view, hedging borrowing with IRF, assuming expected interest rates go up by 6.6% by the 31st of Jan. So this is kind of like my heading. Okay, so the number of contracts, as I've discussed the formula with you, is the loan amount divided by $50,000 into the period for which I need the loan, that is 4 months, divided by the standard period, which is 3 months. Okay, so that way I get 96. Let us just check whether there are any decimals. No, so it's a complete 96 lots that I need to purchase. Sorry, need to sell. So to hedge a borrowing required on the 31st Jan, Brandon shall sell 96 lots of March futures of at a price of 93.95. Okay, we are highlighting the assumption over here. Remember, we need to mention the assumptions in the exam. So assumption, in fact, we could just do a copy paste. Assumption as per the question, we assume futures and option contracts are settled at the end of each month. Basis is assumed to diminish to zero at a contract maturity at a constant rate based on monthly time intervals. It also assumes that there is no basis risk and there are no margin requirements. Okay, so now we decided we know what to do with futures. Now we need to decide that what is the profit or loss that we would make in futures. Now, since there is a adverse movement, okay, that means we are going to make a profit in our futures contract as well. Now, how do we know what would be the price of the futures on the 31st May? Because 31st Jan, because all we know currently, we know the spot rate, that is 94.3. We know the future rate, that is 93.95. You see, future price is already given, right? It's already given over here, 93.95. Okay, so we took the futures price from them. Spot price, well, we have the spot rate, that is 5.7%. Okay, 100 minus the spot rate will give you, you can just write it this way also, 100, or no, I can't, because that over there I've written a percentage, 5.7%, but this is 100 minus 5.7, which becomes your spot rate. Okay. Therefore, the unexpired basis, which is the difference between spot and futures, is 0.35. Months left till expiry is 5 months. You can clearly see that the futures is trading at a discount to the spot. Okay, which means that going ahead also, futures shall continue to trade at a discount, or rather we could assume that since it is trading at a discount today, it will trade at a discount even going ahead. Okay, so as on 31st of Jan, we have assumed that it will be 6.6%. So 100 minus 6.6 is the rate as on 31st Jan, the spot rate. For futures, now if you know that the unexpired basis for 5 months, so how many months are left for expiry? It's 1st of November today, so November the entire month, December, Jan, Feb, and March the entire month. So there are 5 months left for expiry. So you will say 5. Okay. As on 31st of Jan, there is Feb the entire month and March the entire month. So 2 months are left for expiry. So what is your unexpired basis? Is nothing but a simple cross multiplication, 0.35 into 2 divided by 5. Okay, that's how we get 0.14. So we know 93.4, we know 0.14. We just need to find the futures. Okay, since futures is trading at a discount, we shall subtract it. and therefore the expected future rate as on the 31st of Jan is 93.26, right? Now, the actual interest that we take would remain the same, what we did over here. Okay, so same logic, 840,000 outflow. That is the actual loan that you are taking. Okay, where was it? Yeah. Yeah, the actual loan that you are taking is $840,000. Now, if you see, you sold at 93.95, you have to buy to close your position. You will have to buy at 93.26. That means you are selling high, buying low, which means you are making a profit. Okay, so what is the profit you are making? That is 93.95, that is E77, minus 93.26, that is F77, divided by 100. Why divided by 100? Because these are in basis points. Okay, so you are converting it into a percentage, therefore you divide it by 100 into the underlying. The underlying is $50,000, sorry, $500,000, into how many such contracts? 96 into 3 by 12. Okay, so let me just explain you. So firstly, the profit. How much is the profit? 93.95 minus 93.26 divided by 100. That is the percentage, profit percentage that you are making. Okay, now you are making this profit for how many lots? You are making it for 93 lots. How many lots were there? 96 lots. Okay, 96 lots. What is the underlying? $500,000. Okay, and for the underlying is for how many months? 3 months. So 3 by 12. Okay, that's how you get 82,800. Clear? So your cost is $757,000, and the effective rate of borrowing, annualized effective rate of borrowing shall be, okay, shall be 6.31%. How? 757 divided by the actual loan into 12 by 4. In fact, this entire thing could have easily been copy pasted, and all you had to change was this. You could have copy pasted this over here. You need not type everything again and just change the cell references. Okay, so far 757 versus 756. So 756 is cheaper. FRAs are better with 6.3% effective rate, whereas here it is 6.31% effective rate. Then we have options. So in case of options, the number of contracts are 96 lots. Premium paid on these 96 lots is $10,440. The hedge, to hedge the borrowing required on 31st of Jan, Brandon Company buys 96 lots of put March 93.75 and pays a total premium of $10,440. How did we get the premium? Nothing. We are taking 96 lots. See, the calculation remains same as in case of futures. Once you have done futures, doing option becomes super simple. Okay, the only differentiator is the decision, that is buying a call or a put, but it's not technically a differentiator, because if you're selling, that means you need to buy a right to sell. If you're buying futures, then you need the right to buy. Okay, so depending on what you do in futures, the decision becomes simpler. When it comes to options, only true differentiator is, do we need to exercise the option or not, is a question then. Okay, anyway, so the lots is 96 lots. The premium that we have to pay per lot is how much was the premium? Where's the question gone? Yeah, we have to pay 0.87. So in fact, this over here, I can use it as cell referencing. So 0.87. So 0.87. Now these are in basis points. Okay, so 0.87 divided by 100 will give me the percentage into 96 such contracts. Each contract is of $500,000 with a expire or with a period of 3 months, so 3 by 12. Okay, so we get that the premium that we will have to pay for these options are $10,440. So to this outflow gets added. Okay, so in actual interest that you have taken $840,000 outflow plus another outflow of 10,440, then let us see that in options, do we make a profit or a loss? Well, you have the right to exercise at 93.75. So which basically means that, let me write it here, implied rate of strike is 100 minus 93.75, oops, is equal to sign 6.25%. Okay. 6.25% is the implied rate of the strike price. That means if the rate interest goes up to 6.6, we have the option to take a loan at 6.25. So obviously we are going to exercise it. Okay. So, or you can just compare, the better way is to compare it with future prices because the underlying is future. So you do not compare it with 6.6, you compare it with future price. So future price we already calculated over here, 93.26. So we are going to compare it that way. We have the right to sell at 93.75, whereas the current future rate is 93.26. So we'll say, obviously, I would want to sell as high as possible. That is 93.75. So I shall exercise my right. So the gain that I'm going to get is 93.75 minus 93.26. That is 0.49 basis points. Okay, bips. Therefore, the interest payment, the actual interest payment is 840, which has been constant in the all scenarios. The profit that we are making is $58,800 on options. How? 49 bips divided by 100 into $500,000, 3 months into 96 such contracts. Okay, so $58,800 is the inflow or the profit, and the premium that we have to pay, irrespective of whether you exercise or not exercise, is $10,440. Okay, therefore, your net borrowing becomes $791,000, and your effective borrowing rate is 6.6%. Very simple question, to be honest. Okay, very straightforward. There was nothing complicated in this question. And this is how most of your risk management questions are. I don't know what is the stigma that students have against risk management, but they typically are very, very simple questions, usually are straightforward without a lot of complications to them. So I would say that you should consider, or you should be very happy looking at a question from uh, risk management, because you just have to follow steps. Okay. Now you realize 6.6, 6.31, and 6.3. So obviously 6.3 is the cheapest and you will select that. But it's not going to be a one-line solution. Okay, you have to do the ifs and buts, because the media is speculating a rate cut. Okay, in that case, options could possibly be more beneficial, because it gives you the choice whether you want to exercise or not. So if there is a favorable movement in interest rates, um, then in that case, options will be lapsed and you shall enjoy the benefit of favorable rate change. Okay, and you will end up taking. So, say for example, if the loan was at 5% from the current 5.7%, so you would say, okay, I don't want to exercise my right and I'll just take it at 5%. In case of futures and forwards, they are obligations, so they don't give you such a choice. You have to execute at that rate then. Forward rate agreements and futures provide broadly similar results. The outcome of the forward rate agreement is marginally lower and may be the preferred choice. In theory, both methods provide a fixed interest rate payment and certain cash outflows, but futures contracts are subject to basis risk and margin requirements. Now, if the central bank rate increases to 6.6%, the option is the least attractive hedging method due to the expensive premium. Unlike forward rate agreements and futures contract, however, options do not have to be exercised and allow Brandon to benefit from an upside potential if central bank rates were to fall. Treasury staff would need to assess the likelihood and the amount of possible reduction in interest rates when assessing the viability of the option. So you are saying that let the treasury team decide what is the likelihood, okay, and understand that should we do the options, okay, and what are the probability that it would reduce, okay, what is the possibility of it, okay, and by how much, not only reduce, like if it is a 10 bips reduction, well, you are paying that much as premium. So the reduction that you are expecting should be at least more than the premium that you are paying. If you are expecting a 10 bips drop and you are paying 10 bips as premium, then it's not going to benefit you. If the board is to achieve its objectives of minimizing risk exposure, the certain cash flow associated with forward rate agreement will be more attractive than variable outcome with options. Okay, so they are saying that since cash flow is a thing, uh, forwards are better because in options you would have to pay upfront, and also in futures you would have to pay. Okay. Then the centralized treasury department. These are the major points that you should be covering: liquidity management, currency management, funding, and corporate finance. Right? These are the three major functional areas that we also identified. So you can just read through it. Liquidity management. Wait, let me just look at the time that we have. Okay, we have some time. We have about half an hour with us. But that would take up in the next question. Anyways, I'll just quickly read through liquidity management as Brandon expands. Okay, there are a number of functional areas of a treasury department could add value for the Brandon company's expansion plan. First one is liquidity management. As Brandon company expands, the increase in the volume of transaction across the group will require a greater emphasis on liquidity management, including the need to support Brandon companies' working capital requirements. A centralized treasury department could add value by netting off subsidiaries' debit and credit balances, which would reduce the number of transactions and hence the transaction costs. So it will bring down transaction costs and also will help in the liquidity management, okay, by going central. Another advantage of going central would be currency management or currency risk management. The expansion outside the Eurozone introduces foreign exchange risk in the group and the need to manage the impact of foreign currency flows on branded companies' earnings and shareholders' value. Effective currency management include the use of derivatives can have a significant impact on shareholders' value for companies with overseas assets. A centralized treasury department will have the resources to employ experts with knowledge required to manage these risks. It would also be possible to employ techniques across the group, such as matching income earned by one subsidiary with the expenditure of another subsidiary in the same currency, reducing the risk and the need for external hedging methods. Then centralized treasury is better for funding decisions also. The treasury department will play a role in sourcing the appropriate debt instruments and matching maturities to the time horizons of the investment, as well as managing the relationship with lenders. A centralized treasury department could add value by pooling funds required across groups to achieve better rates by borrowing in bulk. Also helps in corporate finance. The corporate finance function would undertake the equity issue to raise part of the funds required for overseas expansion and be involved in the strategic decision making, such as formulating a dividend policy that meets the need of shareholders. Centralized treasury department would have appropriate level of oversights of brand and companies group activities to provide operational Strategic and corporate finance advice to enhance value. It can advise on short-term investment strategies, evaluate subsidiary performance, and manage branding companies' financial structure to minimize the cost of capital. Okay, so these are the functional areas that we identified, four functional areas. Okay, and we wrote a little on all of them. Right? How many marks was it for? It was for 6 marks. Okay, so you could have also stopped at 3 and written it for 2, but just one extra. Actually, funding and capital structure would be corporate finance and funding. It's kind of similar, so you could actually just merge it also. Okay. Any other point if you make would be also valid, but yeah. So from professional marks point of view, the way you present it using all the data available, okay, that had marks. So you had your analysis and evaluation, and then you had commercial acumen, wherein you showed practically that futures do have a basis risk, and they also have to pay margin amount. Okay, let's move on to the next question. Um, the board discussed the financing. Don't think this is the start. Okay, I'm not sure. Maybe this is the start. Anyways, we'll first go through the requirements. Advise Go-Guard company on and recommend an appropriate hedging strategy for the US dollar cash flows on the 31st of August. Include relevant calculations of 15 marks for setting up a hedging strategy. This is a foreign exchange hedge. The one which we did previously was an interest rate hedge. Then part B says discuss the advantage and disadvantages of Go-Guard company using exchange traded currency options compared with OTC currency options. Okay, and I think this question is from an old marking scheme, therefore there is no professional marks here, but in your exam, in fact, in one of the recent test papers, I had seen this question, wherein part B was not asked, it was just part A and part C, which in that question became B, and then there was 5 marks of professional marks. So you see that your paper is actually shorter as compared to what it was previously. Discuss the role of Go-Guard company's treasury function in relation to the management of economic risk. So this is with regards to economic risk, what is the treasury function they are asking, right? So it's some hedge majorly, and then we need to differentiate between OTC options and what is this? Exchange traded currency option compared with using over the counter. Okay. So standardized options versus non-standardized options. Okay, OTCs. Um, Let's read. The board discussed the financing of a project at a recent meeting. Robson corporate bankers have already approved a funding decision of a $15 million bank loan. The finance director is concerned about the following capital providers. External shareholders, the last right issue took place 18 months ago, and there were two others in the previous 5 years. A group of shareholders have formed an action group to exert pressure on the board for more drastic change. This includes a campaign to replace the CEO, which was only narrowly avoided when the shareholders voted at the most recent annual general meeting. The CEO is optimistic about the prospects of a right issue, but suggests underwriting the issue to reduce the risk of failure. Okay, so they require $50 million. Okay, and they already have an approval of raising this through a bank loan, but certain concerns were raised by the finance director with regards to certain providers. So external shareholders may not be happy about it for these reasons, like basically they took a right issue. Now he is suggesting we could do a right issue with underwriting. Then subsidized loan provider, the government funds the subsidized loan program to boost job creation in economically deprived northern region of the country, which is where the new automated manufacturing plant is to be located. Although the loan has yet to be approved, the chief executive is optimistic about the outcome of their application. One feature of the loan program is that it is open to applicants without assets available to provide security, although other restriction may be imposed. So you need not give a security, and as in you need not give a collateral and get it at a cheap rate, but there are certain restrictions. This is relevant to Robson since surplus assets were disposed of during the turnaround strategy, and those would remain be used to secure the new bank loan. Okay, so those terms and condition could involve, like, you cannot dispose of the asset, which actually Gogart has done recently and maybe plans to do in future. But it won't be able to do that because your asset would be used as collateral. Um, the following exhibits available on the left hand side. I think Robson. Okay, okay, okay. I think this is relating to another question altogether. Let me just delete this. This is a Robson company. We were doing another company. Sorry about this. Just a moment. Yeah. Just write this as question 2. Oops. Okay, this is question number 2. And that one was question 1. Previous one, what we just saw. Anyway, so yeah, 2A, advice Gogart company on the recommend. Okay, now we need to read sorry about that. We'll read the actual question now. Gogart Company is an electrical equipment manufacturer based in Malaysia, looking to develop its operations abroad. One of its biggest sale market is the US, and Gogart Company also imports components from the US. Gogart Company regularly hedges transaction on foreign currencies. It is currently the 1st of May. On 31st August, Gogart Company is due to pay 14.5 million dollars to an American supplier and receive 37.4 million from an American customer. The following quotations have been obtained. So right off the bat, firstly, we can clearly see that we are based in Malaysia. We do transactions with US a lot. We have both imports as well as exports. So currently it is 1st of May, and coincidentally on the 31st of August we need to pay 14.5 million, and we are to receive also 37.4. So we can just net these off and say our net exposure is 37.4 minus 14.5, whatever that is our exposure, right? The exposure arises on, or we are to receive the net amount on the 31st of August. So that is, today is May, June, July, August. So after 4 months, we are going to receive this amount. Okay, they have given us a spot rate, they have given us a 4 months forward rate, and this is relevant because we are looking at 4 months only. So this is the relevant 4 months forward rate. Now we need to select which rate applies to us. One way of going about is uh, converting the amount at both the rates and seeing where you are to receive less. Or the other way to think about it is, how is the quotation given? So 1 MR is equal to either $0.2355 or $0.2358. Now, if you are to receive dollars, you will take those dollars, go to the bank, give bank dollars, and bank will pay MR to you. The bank will pay 1 MR and take obviously more dollars from you. So that means it's going to take $0.2358 from you and in exchange give you 1 MR. Okay, so the correct rate will be 0.2358 for us, or the more relevant rate will be that. Okay, 4 months forward, similar logic, so it will be 0.2374. Now, currency, futures, contract. Um, Contract size is $500,000. Sorry, 500,000 MR. Future prices are quoted as dollar per MR. Now, we first need to determine that June futures or September futures. Well, it is the future. The expiry will be immediately after settlement date. Settlement date is 31st of August. So after August, May, June, July. So June comes before August. So that means September is the one that we will have to go with immediately after the expiry. The September contract. Um, Now, do we buy it or do we sell it? Okay, so in order to answer that, we need to ask what's in the box, what's the underlying currency. The underlying currency is MR, it's 500,000 MR. Okay, so what are we going to do with MR? Well, we are going to receive dollars. We're going to sell these dollars and buy MR. So that means we have to buy future contracts. We are going to buy the currency of the contract, therefore buy the future contract. So we are going to buy these contracts. Now, how many contracts? We need to see our exposures in MR and accordingly we decide how many contracts, right? In case of options, now since we have already taken a decision over here in futures that we need to buy futures and the underlying is same, that is 500,000 MR. So here also we need the right to buy. That is, we need call option. And we shall select September, okay, and strike price, which is nearest to the current spot rate. Okay, in case there were more strikes available, but in this particular question, there's only one strike available, right? Futures and option contract mature at the month end. The So this is given to us one example, one assumption. The number of contracts to be used should be rounded to the nearest whole number in calculations. If the amount cannot be hedged using an exact number of futures or options, the amount under or over hedged should be hedged using forward market rate. Okay, so forward market rate is given to us over here. This is the rate we shall use in order to hedge the overhedge component or underhedge component, right? For the purpose of calculation, it should be assumed that the options are exercised. So they may not have given us information for whether to exercise or not. So, but they have just given us the decision. Okay, so we need not take a decision. They have said clearly that you need to exercise your option. So first off, let's begin. What are we expecting to receive? We are expecting to receive 22.9 million, which is nothing but 37.4 million minus 14.5, which is $22.9 million. Okay. Now, if we were to use forward contracts, so there are two rates available, 0.2370, 0.2374. We just have to identify the relevant rate. We discussed already the correct rate is 0.2374. You will have dollars with you. You will sell those dollars and get MR in return. So for every 1 MR, they are going to take as many dollars from you as possible. They will never take less dollars from you. So they are going to take 0.2374. All the foolproof way of getting it is just convert. So one rate is 0.2370, in which case your MR will be 96.6 million. Okay, and if you convert using 0.2374, your MR will be 96.4. So since 96.4 is less, we shall select that rate. So net receipt on MR on conversion when hedging with forwards, it is 96.41. Sorry, 96.46 MR. Okay, so that 22.9 million dollars will eventually get converted to 96.4 million MR, right? After 4 months, if you are using forwards. Now it's forward, so your rates are essentially fixed. There is no fluctuation. Okay. Now hedging with net USD receipts using futures contract. Should we buy or sell? We shall buy because we are buying the underlying currency of the contract. Okay, so I have given an explanation also over there. Then which expiry is September because it's immediately after the transaction date. How many lots? Well, ideally you need 192.92. So how you are doing it is you are taking the um, exposure in MR, okay, assuming that you are converting it at forward rates, you are taking the exposure in MR and then dividing it by your total exposure, as in this would be, just a moment. Okay. Um, the way you are doing, don't we have a future price available? Yeah, we have it, 0.2378. Okay, sorry. So how do we calculate the lot? Wait, I'll just do the calculation over here. So what you are doing is you need, let me just give more explanation so it's easier for you to understand. Okay. Exposure in USD is $22.9 million. Okay. Therefore, exposure in MR. Okay. If you had to convert these dollars to MR after 4 months using futures, okay, what rate will you get? So you have to find something known as the lock-in rate. Okay, why lock-in rate? Because you are not given the future spot rate, you are not given the future rate. Since the future spot rate is not given as on 31st of August, how are we to arrive at the future price? It's not possible. Okay, so we need to find something known as the lock-in rate, and that is the reason why in the question only they said you need to exercise your option, because we don't have a future rate available, right? So since we don't have this, we shall directly calculate something, the lock-in rate, calculate something known as the lock-in rate or the effective rate. Okay, lock-in rate or effective rate is equal to the current future price minus unexpired basis on the transaction date. Okay. Now there are various ways in which you can calculate your lock-in rate. This is one of those many. Okay, you could use interpolation. You could also have a formula which is starting off with spot. Anyways, we are following this, right? So which is current future price, which we have. We need unexpired basis on the transaction date. So unexpired basis as of today is the difference between spot and futures, which is 0.002. uh, how many months left for expiry? It's 1st of May. So May, June, July, August, and September. 5 months left. And transaction date is on 31st August. So from August till September is just 1 month. Okay. So 1 month is left for expiry. Now using that, we can find the unexpired basis doing a cross multiplication. Now, since we don't have spot, we can't find futures, but we can do a lock-in rate. So lock-in rate using the formula is future rate, the current future rate, minus the unexpired basis. But this is already in minus, so we are doing plus. Okay. And you arrive at your future lock-in rate, right? Or rather, you could write this as, okay. So you arrive at your future lock-in rate. So this is the effective rate at which it will get converted, or expected. You could call this expected future lock-in rate, because it's based on estimates on or based on the assumption that basis reduces to zero in a constant or a linear manner. Okay, see over here we have written that uh, what do you say, assumption. Okay, so you find your expected lock-in rate. That means this is the rate which eventually you would have to execute your transaction at. So 22 million 22 point what 22.9 million dollars will get converted this much. Okay, so it's going to become, sorry, we have to divide, not multiply. Okay, it will become 96 MR. So this is not dollars now, this will become MR. Okay, so number of lots will be, you need these many MR to be hedged. The standard lot size is, what is the standard lot size? Wait, 500,000 MR? Yeah, 500,000 MR. Okay, so you got this 192.92. This is how you got it. Okay, which you round up and say 93 lots, which means you are over hedged. Okay, so you should have ideally taken 192.92 lots, but you end up taking 193 lots, so you are over hedged. So we shall hedge by buying 193 lots of September futures at a price of 0.2378. Okay, so this basis part we have already discussed. Lock-in rate we got. Let me just delete this. Yeah. Right. So now if you look at the actual transactions, the net receipts that you are going to receive is 22.9 million net receipt in MR. Okay, we are using the effective rate and telling that, okay, we are receiving 96.461 MR. Okay, lot size is 500,000 MR. Actual receipt, okay, is actually we are receiving 193 lots into 500,000 MR, which means the actual receipt when you exercise your not exercise, but when you execute your futures contract will be 96.5 million MR. Okay, so this is, you would say, uh, your futures market. Okay, this is your futures market. All right, this is your futures market. So in the futures market, what is happening is 500,000 MR you have hedged, okay, and how many lot size, number of lots. So I'll just write it. So 93, sorry, right? It was, yeah, sorry, 193. Okay, so actual receipt will be futures contract. Okay, from futures contract it will be 96,500. Right, so the amount that you have overhedged, okay, you will say that is $9,100. How did you get $9,100? We are converting these into, so if you had to write them in dollar terms, right? So you will just say this, okay? So amount overhedged can also be written as that, this minus, so $9,100. Okay. So this amount of $9,100, which is overhead. See, understand what is happening is you have taken 193 lots. That is 500,000 MR per lot, which means a total exposure of 96.5 million MR. Okay. For this, so when you go to square off, or when you go to settle the account, okay, they are going to ask you for 96.5, which means they are basically asking you for 22.909 thousand dollars. Okay. Which basically means an extra of $9,100 needs to be arranged, because you are to receive only 22.9, but your hedging is going to ask you for 22.909. Okay, so 0.09 extra needs to be arranged. So how are you arranging that? You need to hedge that component also. So that component we are hedging via uh, your forwards contract. So over here we need to buy, that is, we need to buy additional $9,100 and hedge that buy. Okay, so we need to buy that additional $9,100 and hedge it. How are we hedging it? Okay, this 9,100 using forwards rate. Now understand, we selected this rate 0.2374 for receipt. Okay, it is a net receipt, but here it is a payment. Okay, we need by hedging that payment. Okay. So the additional hedge which has been given in the exam, sorry, in the question, is to be done using forward rate. So you are not using spot, you are using forwards, 0.2370, and this is how you are paying extra. So the final outcome is, in the futures market, you are going to receive 96.5. Okay. Payment for over hedging is minus 38. Okay. This is an outflow. This is inflow. This is outflow. So net you are receiving 96.46 million MR. Okay. So that's your net receipts using futures. Right. No. These many MRs. So this is using futures. This is using forwards. 96.461. This is 96.461. 603. 668. So slightly more in forwards, right? In futures, it's slightly less. But again, futures technically are exposed to basis risk. So we may in fact get less than this, or may even get more than this, because we took an assumption. In reality, there is basis risk. Also, margin needs to be paid. So all that can be highlighted to score those extra weeks. Now, moving on to options. Well, in options, they have clearly given to us that we need to exercise now, since the decision taken over here is to buy futures. So we need to buy the right to buy, that is call options. Expiry is also easy to select, September immediately after expiry, same as in case of futures. How many lots? So that has been calculated, 193. Now over here, it changes. Okay, why does it change? Because you are converting it at the strike price. So the strike price over here is different from the lock-in rate over here. The lock-in rate over here was 0.2374, whereas the lock-in rate, or the strike price, or the executable price, is 0.2368. So based on 0.2368, we shall calculate the exposure in MR. So if you want to do it, how we are doing it is receipts to be hedged is these many dollars. Okay. In MR, it will be, this is in USD. Okay, so you need to convert this at the strike price. So if you use option, that what price can you convert it at? Obviously the strike price. That is, if you get a better deal, great, but otherwise minimum, this is what you shall get. You could in case of option, you can't get less than this. Okay, you could get more but not less. So therefore, number of lots will be, well, I have an exposure of this much. My standard lot size is 500,000. Okay, so 193.41. That's how we did it. Okay, or you can do it directly. With practice, you can start doing all these things directly. So strike price is 0.2368. It's already given in the question. So we pick this up from the question over here, which is 0.2368. Okay. This is from the question. Premium also we have picked it up from the question, 0.14. So we need to pay a premium. Okay. So premium paid today is 0.14 into 100, sorry, B79 divided by 100, because these are in US cents. So we are converting it into dollars. Okay. So 0.14 cent is basically 0.14 divided by $100, right? And these dollars, we are converting it at the strike price. That is where is it? Okay, sorry. We are converting it at the spot rate. That is 0.2355 into 193 into 193 contracts into how many the underlying contracts are. Okay. So, okay, I'll just re-explain this part to you to avoid any confusion. So how much premium are you paying? So firstly, per lot, premium per lot is, this is cents. Okay. So premium per lot is 0.14 cents. So you are first converting that into dollars. So you are saying that 0.14 divided by $100. Okay. Now these dollars you want to convert it into MR because you are a Malaysian company. You need to pay in MR. So you will pay at the spot rate. So the spot rate is um, this. Okay. So you're executing it at the spot rate. You can probably put this whole thing in one bracket. Okay. Now this is for one contract. Like this, you have how many contracts? You have 193 contracts. Okay. So 193, and each contract's underlying is 500,000 MR. Okay. So this is how you arrive at your uh, They didn't take the spot rate, they took the futures 2355. Just a moment. Where's my strike? 2368. I think this is wrong. This should be the correct one. Okay, there's a small difference because this conversion needs to be done at the strike rate. They have taken 0.2355. I'm not sure where did they get that 0.2355 from. But let's read the question. Is there some... Oh, okay, it's the spot rate, but I took the wrong spot. Sorry. That was for... It will be this spot. We are to receive, right? Okay, see, there are two spot rates available to us, 0.2355 and 0.2358. Now, these are the dollars that we need to pay, correct? We have to pay premium. So we are going to take our dollars and ask for MR. So for every one MR, obviously the government or the banker is going to take more dollars from us. So it will be 0.23. Sorry, wait. See, what is happening is, let me put one more over here. Okay. Exchange, spot exchange rate. Okay. Now we need to pay in dollars, right? That means we need to pay 0.14 cent, right, for every unit. So, or okay, per lot is this divided by 100 into what's the underlying? 500. Okay, $700. Okay, the underlying is an MR. Okay, wait. Okay, let's just skip this. Okay, see, what is happening is we need to pay 14 cent per unit. Okay, so we are first converting it into dollars. So we need to pay in dollars, basically. Okay, we are a Malaysian company. We do not have those dollars. So we need to purchase dollars, right? Now, what spot exchange rate to purchase dollars in order to pay premium? Okay, so spot exchange rate that is applicable in order to purchase premium. I'll just... right, is equal to, now you have the spot rates available over here, 0.2355 or 0.2358. Now here you want to purchase dollars. That means you are going to go with your MR to the bank and going to purchase dollars. So the bank is going to take MR and is going to give you dollars. So obviously it's going to give you less dollars. So it's going to give you $0.2355. Okay. Yeah, 0.2355. So you are going to say is 573, 673 MR. This is how we got our MRs. Okay. So we start off by saying that we need to pay this much premium, right? 14, 0.14 or 14 cents. Sorry, 0.14 cents divided by 100, that many dollars. These dollars get converted at DEC. Okay. So we get how many in MR terms we have to pay, but for 193 lots and for 500 500,000 is the underlying per lot. Okay, that's how we get our 573 673 MR, which is the premium that we need to pay. Now the amount which we are under hedging, right? So since we are executing 193 lots and not 193.41, that means we are under hedging. How much? So that is C25. C25 is or actually we could have just taken because I've put it over here, but yeah, let's just bring it over here. C74, let's change it to C74. Oops. C25 is your, yes, 22,900. Okay, it's B24. Why isn't, oh, sorry, B74. Yeah. Okay. Your exposure is of 22.9 million, right? But using the, what do you say? Using the hedge, you are hedging 193 contracts of 500,000 MRs each, and the exercise price is 0.2368. So you could just say exposure under, leave. Let's just do it because we don't have time. Okay, so you see 190, your actual exposure is 22.9, but under the hedging, okay, or okay, I'll just write. So how much are you hedging? You are hedging 193 lots. Each lot has 500,000 MR, okay, and the exchange rate or the effective exchange rate will be your strike price. Okay, so you are hedging these many dollars. USD hedged by what are we doing? By buying 193 all options. Okay, is this many million pounds, dollars. So under hedged is 22.9 minus 22.85, which is 48,800. Okay, these are just alternative calculations, or you can do it directly, right? Now the receipt at the forwards rate will be 205,000. How? Well, you know that this is under hedged amount which you are going to hedge via forward rate. So you should have hedged for 48,800, but you haven't. So now you are hedging it using forward rate. So for forward rate hedge, we had already identified this is the rate. So we are going to stick to that rate. Okay. So receipt at forward rate, or receipt, or the amount under hedged. You can also write this as amount, under hedged amount to be hedged using forwards. Okay. So from forward contracts, you are going to receive 205,000 MR. So your net outcome from option market is, well, you are going to receive your 96.5 million MR, right? 193 contracts, 500,000 from each. So you're going to receive that much. Receipt on under hedging. This is what you're going to receive on under hedging. Premium that you are paying, we already calculated that. So this is inflow, this is inflow, this is outflow. So net, you are to receive 96.1 million MR using options, right? So then we just have to compare everything, 96.1, 96.461 and 96.461.6. This is a little more. So you are going to say best thing to do is forwards. But if the rates actually move favorably, then options would have been better. But nothing of that sort is given. We don't even know what the rates are. So the recommendation is that a forward contract gives a marginally higher receipt than the futures. Futures would be subject to basis risk, and the risk that is the risk that the difference between future price and spot rate does not decrease linearly towards the maturity of futures. This means that the receipt may be uncertain. Futures also require margin payment and initial payment of cash into a margin account operated by the futures exchange, which further payments if losses are made on contracts. Okay, which means maintenance margin needs to be paid then. Options give a lower receipts because of the premium that needs to be paid. Go-Guard company may consider options if it considers there is a chance of the dollar will be in a stronger position against so dollar appreciates, okay, then MR. Then we suggest would be suggested by the forward rate, or if one of the transaction is likely to fall through. Overall, Go-Guard company would choose forward contract as it offers the marginally higher receipt and is not subject to basis risk. This is how you will conclude. Okay, I think we'll end for the day over here. The theory part of it is pretty simple. Okay, you just have to discuss the advantages of OTC or difference between OTC contract options and exchange traded options and the treasury functions. Okay, so in fact, I'll just show it to you. The advantages are over here. You can pause and read through. Is my head covering anything? No. Okay. Pause and read through. Pause and read through. Okay. And then for the other part, that is risk management, the treasury management. So pause and read through. Pause and read through. Pause and read through. All right. And this is some additional information for that which you could have used about Go-Guard. Okay. So this is what we discussed. So with this, we are done for the day. Again, sorry, I extended another 20 minutes than our scheduled time, but yeah, I think maybe we should do a 2.5 hour sessions any which ways. Probably tomorrow we'll do it that way, or maybe I'll skip. Let me know what would you prefer. Would you prefer me doing proper questions or focus on a little bit on theory and then do questions as well? Okay. So that's it for today. Today was day 3. Please watch the previous days if you haven't. We shall meet tomorrow, day 4, where we shall be discussing another topic. I think we are discussing reorganization, restructuring. Okay. So thank you all for your time. I hope today was of value. You learned things. I'll see you tomorrow. All the very best for your exam. Take care.